Welcome, everyone, back to another episode of Frank Finance, where you can get your honest financial information and your questions answered. Today's discussion is really going to be talking about taxes. How do you think about your income against your deductions, and what does that mean? Do you owe the federal government money? Does the state owe you money? We will get into that, so stay tuned. Alright, so before we dive into it, if you enjoy the video, please like, subscribe, and comment. And all documents that we talk about will be available in the Discord link below and hashtag finance files within the Discord, which is all free to you. Alright, so what I have in front of you is a 1040. This thing is disgusting. For anyone that's never really filled this out, this is where it can get overwhelming, which is why I highly recommend that you use TurboTax or H&R Block online. It's very simple to walk through it. I personally use TurboTax. It's phenomenal. I enjoy it. I've never had an issue with it. Although I run my own numbers on the side as a CPA, it makes my life easier to fill it out online. It costs me like, $60, $70 in total to use it. Highly recommend it. So behind the scenes, this is what's happening. When you fill out all the information, it's basically this top section, your filing status, your name, etc. Down here is all the nitty-gritty of the information. What's your gross income? What is all the other things like interest, dividends that you need to think about, any deductions that you have to get to a taxable income amount. And when you have a taxable income amount, basically that then is getting applied against the brackets, which the United States has brackets that go in tiered structures. So for the first 10,000, let's say you pay 10%. The next 10,000 you pay 12%. The next, etc., etc., etc. You don't ever go, okay, once I now make $50,000, now all of my income's at the top bracket. No, it's tiered. So each bracket goes up and up and up, and you pay the incremental percent on the next portion of dollars, which we'll talk about here. But what I want to do is I want to simplify this for you guys and just show you in an Excel document the easy way to think about this and maybe do this on your own. All right, like shown before, you have to think about your income, your deductions, and compare that against what the federal and state government would say you owe versus what you've paid in or what your employer has pulled out. So starting with the income here on top, basically you have one job or two jobs, you have interest or dividends, you add all of the income up inside of here. You're probably like, well, hold up, I've held my stock for longer than a year when I sold it. That's a whole nother video, another discussion. This is mainly for just the basic illustrative purposes. So all short-term or termed ordinary income is within this discussion here. So you add all this income up, you get to call it this individual ABC123 is at $50,440. And then you think of the deductions. The standard deductions that are normally out there would be things like your health insurance, vision, dental, HSAs. Do you contribute to a 401k or traditional? Do you have student loan interest? Maybe there's some other smaller deduction items out there that are worth thinking about. And then the final big one, which is, do you itemize or do you take the standard deduction? Now, there's a big overhaul with this under the new tax code that was under the Trump administration. Basically, a lot of things were simplified, removed, or changed. Certain areas were benefited, obviously, with brackets being lower. And so with that being said, though, when you itemize, you have to exceed the 12,400 threshold. So what can you itemize? Property taxes, your mortgage interest, your state taxes, and then also if you donate or have medical expenses in excess of a certain threshold of your AGI. That's more complicated. I don't want to get into that in this video. But with all that being said, all of this information is available to you on your paychecks. And so once you sum up your total income, you less all your deductions, now this is your taxable income. Income less deductions. That then gets applied against the tiered structures that I was talking about to create your federal and state taxes. And then you compare that against what was withheld, which is also on your pay stub. So now what I'm going to do is I'm going to open it up. There's a lot of buckets here. This is for you to go in and play with yourself. And again, it's in my Discord and hashtag finance files, link below, where you're able to type in your interest, your dividends, maybe other things, if you've itemized in the past, to get to your other miscellaneous income that needs to be summed over here. If you're itemizing, what's your property tax at? What's your state tax at? What's your mortgage interest at? And then did you donate it all? Okay. Does that amount exceed the $12,400 as an individual? If the answer is no, then you take the standard deduction. You don't need to itemize. Now, two things to note. For SALT deductions, which is your property and state taxes, cannot exceed $10,000. So those that are in high tax states, more than likely, you're going to hit this threshold. Or those that have very expensive houses, you need to keep in mind that mortgage interest that you pay can only be deductible on $750,000 of principal. Now, that probably the viewers that would be watching this aren't going to be in any of these buckets. And frankly, itemizing is extremely difficult now. Very, very, very difficult. And just to flash to show, there's a second tab here for you for married individuals. If you were to think about that, married couples have to break $25,000. That's a lot. For two individuals that may call it $50,000 a year, their state taxes are probably going to be around $3,500. These are just illustrative purposes, by the way, using Minnesota numbers. And from a property tax and mortgage standpoint on a $250,000 house, this is roughly what you can experience. There's no way they're going to itemize. So it's extremely difficult. You would have to have an unfortunate medical experience or expenses for that to actually happen. And so itemizing is nearly impossible now for married couples. The percentage that actually itemize are so small. But for on a positive note, if you don't have a house, you get the full $24,800 deduction, where in the past, people that got that type of deduction when you were married typically had to itemize to get there. So it's great. It's nice and simple, especially if you don't own a house. You probably experience better deductions through that. All right, so let's get back to this now. So on the front here, what are some other things to enter in? So I was talking about the deductions. Well, your paycheck, whether it's on job 1 or job 2, is going to have your medical, your dental, your vision, your 401k. Again, only 401ks or IRAs that are traditional, meaning they're taxed after you pull the money out. So tax deferred, meaning you put money in tax free. So you get a deduction against your income today. And then if you put any money into a flex or an HSA, mind you, it has to be you putting the money in. If your employer does, it is not tax deductible. Okay, so those are the most common deductions that you would see on your pay stub. And then when it comes to withheld taxes, you have a federal, you've got Medicare, Social Security, and your state taxes. These are also referred to as FICA taxes here in the middle. Less concerned about FICA taxes. The big thing you're looking at are federal and your state taxes. So now for when we went through this, you go enter in your information in the yellow stuff. You get your gross pay or what you think it is. This will then build up your taxable income. So then down here on the bottom, here's the tiered structures that I was referencing. So for this individual, $30,000 in income. They do exceed the first bracket, which is 10% on the first $9,875. Then that's taxed at 10%. Now the next, call it $20,000, is taxed in the next bracket. So the next $20,000 is taxed at this. They do not exceed $40,000, so they don't have to go into the next bracket, which is a big jump. But again, it's a tiered structure. It's only incremental dollars paid on the new tax bracket. And then for the state of Minnesota, here's what the state taxes are for this group. So now this calculated the tax for the state and federal that this person would owe on this true amount of $30,000. Their pay stubs said that they had $3,500 withheld. They owe $3,400 to the state. The state taxes say that they owe $1,700. Their company withheld $1,750. This would say then they have a refund. Now, other things to think about is there's things like deductions and credits. Credits are going to be those items like the American Opportunity Credit. Did you just get out of college? Or maybe parents get this for those that cover off on their dependents or their children. And that credits are things that are true money, dollar for dollar back to you that you can get. Maybe you didn't get your stimulus check in the beginning of the year, or maybe you have children. The child credit for those under the age of 17. This would be an example of that as well, where these are true dollar for dollar given back to you. That would then be something to think about, and that again would be for another video to go into all these tax credits. There's no way I can make a 10-minute video on taxes. This is the simplistic way to think about it, and the majority of people are going to have 1 or 2 jobs, maybe some interest, and the simple deductions of the basic things here. There's obviously books and videos and hundreds of different things to go look at. Areas that I would recommend is just using Google if you're trying to look up one area of an item. Just like I'll give you like one example here. Student loan interest. Okay? Only 2.5K of the student loan interest is considered a deduction. Okay? Not a credit, a deduction. But if you make more than 70,000, it starts to phase out. If you make more than 85,000, you don't get any of it. It's gone. You're basically then at that point it's the equivalent of any other loan. You can't use it as a deduction. So things like that, I would highly recommend you go out to Google, thetaxfoundation.org, phenomenal. Great information out there to look up the most common things, or I could also make a video on them. All right, I hope walking through all this information on your income, your deductions, and being able to stack that against what maybe you owe versus what is withheld was informational for you. Any side questions, please comment below and I can make a video about it, or we can talk about it during my podcast on Sunday nights. Also, I strongly recommend if you have 2 jobs that you really look at this, because for instance, if you're a teacher and you have a job in the summer and your normal income comes obviously through the school district, the summer job isn't going to know that, and they won't withhold enough federal and state income taxes, and you will end up basically getting slapped when you finally file your return. And this is something I would highly recommend you go through and fill it out yourself and see what does it spit out. And I can always help you with it if you have any questions on it. But as always, have a great rest of your day, and I hope you enjoyed this. Thank you.